Good morning, I'm Chris Beecham. Welcome to this live non-farm payrolls special. We're looking ahead to the US jobs report, which was released in about 5 minutes time. Remember, this is an hour earlier than normal due to the UK time change last weekend. It's another week before US markets come back to normal. And we're expecting a decent bounce in job numbers for the month of October. Looking for 200,000 jobs to have been created last month, and that's a notable rebound from the 134,000 we saw in September, which of course was mainly hit by the hurricanes and the poor weather, to say the least, in the Caribbean. Unemployment rate to move to 3.7%. We're still well below that 4% mark and moving closer and closer, or even further, into what you might call full employment. And average hourly earnings, as we've been saying for what feels like quite a long time now, the main figure to watch for really. It's expected to rise 0.2% month on month and 3.1% year on year. So moving on, looking for CBR FX markets heading into the release, just 4 minutes away now. Euro dollar slightly up on the day, 0.24% higher at 1.14. Pound against the dollar still strongly up on the week, but slightly lower so far this morning. And then dollar yen also up on the day, but only just 0.1% higher. And we are joined by Anthony Karachi from Phoenix Partners. He's an FX specialist. Welcome to you. Thank you for joining us.
Thanks for having me.
We're looking for a decent bounce in non-farms this month, what you call a rebound from last month's poor numbers. Do you think this will have much of a bearing on what we see from the Fed, of course, next week on Thursday?
I think the Fed we're not expecting the Fed to raise rates next week. Obviously, they meet on Wednesday. The futures market's priced in a 7% likelihood of an interest rate hike in December, and then 3 more next year. That's the idea.
Beyond that, though, do you think, we were saying about the wage numbers, clearly this is the key thing to watch out for at the moment. Do you think this would, a notable bounce here would provide any sort of further, perhaps, push lower for euro dollar? Yeah, I think so.
I think typically, historically anyway, the non-farm payroll figures were heavily scrutinised on the employment side. Average earnings is taking the front seat a little bit more, obviously linked to inflation. I think typically a tighter labour market is forcing employers to actually pay more, although labour costs are quite low. So it's one to look out for.
Yeah, it has been, I think, a notable sort of change in the story the last few months. I think the Amazon, their much heralded move to increasing their minimum wage seems quite a big move. I think it's something that you might start to see through the US market more generally at the end of the rest of the year?
Yeah, I think so. The labour market has become robust. We're at 49-year lows on labour, employment lows 3.7%. Inflation has dropped off, but it was still over 2% plus 7 months. We're at 2.3 versus 2.7 from the month before. And obviously GDP has been key. 4.2 at the high, 3.5 now, and it beat expectations, which was meant to be at 3.3 last month. We have to factor in, of course, the hurricanes of the last couple of months, which I guess were cited for the drop from last month. Good.
I think moving on we should move on to indices, see where the markets are trading ahead of those numbers. Let's start with European markets, and a good strong bounce across the board for those European markets. The FTSE up over 1%, 7,174. Germany 30, the DAX, Germany 30 on our platform, was 2% higher. And France, I think, playing catch up after on a holiday for French markets yesterday, up 1.6%. Moving over to the US. And similarly, another strong performance. Wall Street in particular up almost 1%, closing on at 26,600 mark. Once again, see if the president can get us back above 26,000 before midterms, of course. The US 500, the S&P 500 up about 0.6%. And US Tech 100 still weighed down by those Apple numbers last night. Unchanged so far on the day, but still holding above 7,000. We have seen, of course, those indices bounce strongly from those lows at the end of last week. Anthony, looking at going back to euro dollar, I think is perhaps the key one to watch ahead of these numbers. We've seen it begin to rally off those lows, and you can see it there back above 114. I think the question is, how do we think a strong non-farms number, or indeed a weak non-farms number, start to play into this in terms of expectations for euro dollar and indeed maybe ECB policy as well?
Yeah, I think, well, the past 48 hours you've seen the dollar come off, mainly because obviously I think generally the Trump factors, obviously with China and trade problems there. The tweet yesterday set off emerging market currencies and strengthened. That's why we saw the dollar off a little bit more. Perhaps it was more of a dollar story than maybe a sterling story or euro story as well. ECB, of course, I mean, they have, well, I think the Mario Draghi and co have cited that perhaps by the end of the year, they would look to, I guess, trim their balance sheet somewhat.
Excellent. So we get the numbers coming through right now. You see euro dollar on the chart, and that's 250,000 jobs created during the month of October. So once again, breezing past expectations. Unemployment remaining at 3.7%. You can see euro dollar continuing to drop there on the chart. And then last month's number revised down to 118,000. So clearly the first number always still wrong there on that point. Further weakness coming through overall from those job numbers. And finally, average hourly earnings in line with expectations at 0.2% and month-on-month, and 3.1% year-on-year. So moving to these markets now, if we can go to those FX markets more generally, we're certainly seeing euro-dollar beginning to drop back. This is the 1 minute chart there, so quite a sharp reaction in the immediate near term. Moving over, if you just move over to pound against the dollar, and still also holding up quite nicely. After what has been perhaps a difficult couple of days for dollar longs, where the pound is concerned. If we're looking at the broader FX space, and you can see that, as you can expect, pound essentially unchanged on the day for the time being, but euro dollar recovering slightly, still above 114. But the big mover so far on the day, dollar yen, definitely one to keep an eye on. So if we move over to perhaps looking at dollar yen on the chart there, we'll see on the 1 minute chart there, you can see quite that bounce. Impressive bounce, and what is a currency pair that has been moving steadily higher over the last few days. And indeed, looking at going back to the daily chart there, just to get the longer term view, that's the move from the lows over the course of March. Anthony, dollar yen wise, what do we think this could mean longer term for US monetary policy, and indeed this particular currency pair?
Yeah, I think considering what we've seen today, testament to average earnings and unemployment. Unemployment's still very, very low. Average earnings are going up. The tightening labour market, and also the Fed citing that there is obviously more hikes to come next year. They're in a bit of a dilemma a little bit. I think Donald Trump's been criticising the Fed somewhat, Fed Jay Powell particularly, over his aggressive, I guess, monetary stance. The tax cuts that he did this year, when they come into effect, will they slow down next year? Will they affect GDP? So these things they have to really take note on if they're going to keep hiking aggressively into next year.
Do you think we could see perhaps a pickup in pace of hiking if perhaps the data continues to come in ahead? I mean, 250,000 is better than expected, even if wage numbers are only just in line with forecasts.
Yeah, I think obviously they're looking for 3 next year. Markets are looking for 3. So depending on the next bit of data for next year, particularly on Q1 and Q2, should we see anything movement? It'd be interesting to see.
It certainly is, I think, finely balanced at this point in time. I think we were talking about the impact of course, midterms next week. We can't leave those out of the picture. It has been a very important and so far a closely called race. Now we know the perils of predicting what's going to happen to markets in the wake of an election. We remember 2 years ago with the actual election itself, of course, and the fact that few of those predictions came to pass. But if we look at dollar index, we've seen the dollar basket on the IG platform. You can see we've been steadily moving higher the last couple of months, or indeed since the lows in January and February. I suppose the big question is now, can we see dollar continue to move higher, or do we see perhaps further weakness in the near term?
Well, the consumer confidence in the US is its highest since 2000. That's big. Employment opportunities are plentiful in the US. If you look at all the data in the last 12 months or 18 months, clearly as a powerhouse, they're way in front. So do investors or people who are looking to vote next week into the midterms look at the numbers, or they're looking at actually their government? It's difficult to tell. It
is, and if you look at the approval rating for Donald Trump, it's something like 44%, in line with the low figures we've had for the likes of George Bush in 2006. And if you go back sort of 60 years to Truman, and both of those suffered heavily in the midterm. So I think with the risk is, of course, that you get a divided government in the US, and that makes life much more difficult, particularly for the likes of infrastructure spending as well. Well,
he'll have very difficult times passing anything through Congress if he's going to lose seats in the House.
I think so, and of course there was always the risk, although it seems sort of far off at this point, that impeachment gets brought up as another possibility. I think that's probably a destabilising influence for US dollars, to say the least.
I think so. I think markets like the Trumponomics a little bit to a degree. Equity markets love it, global markets like it as well. So it'll be interesting to see.
It's worth keeping an eye on gold, I think, as we head towards the actual opening of US markets in an hour's time. You can see there gold back up at the highs of the day. This is the daily chart, up towards 12.35. Crucially though, I think this one still bears watching, because if you look at the last 48 hours or so, we've seen gold trying and failing noticeably to break that 12.40 level. I think that's the bigger problem, a stronger dollar arising from those non-farm payrolls, which arguably is a very good number. We should see perhaps more weakness for gold in the near term. And if we can get a reaction on US equity markets as well, you can certainly see. Look at the three there for the US equity markets. You've got the Wall Street cash, the Dow still up 0.7% heading into the beginning of the session, very mirrored by the US 500. The Nasdaq 100 still doing its thing, a bit weaker on the day. If you look at the actual 5-minute chart for the S&P, this is, of course, a very short-term move, but we've seen it just come off the highs. A bit of dollar strength coming into the picture. And then finally, there's your hourly chart for the S&P 500, just holding on to what has been a very strong game. We've gained nearly 130 points from the lows of the week. So I think a bit of weakness heading into the end of the session or the end of the week for Friday is certainly worth bearing in mind. And just moving on, European equity markets as we head towards the close of this broadcast. We're looking towards the FTSE up 1%, 71.65. The DAX, Germany 30 on the platform, 1.7%, and France 40 cash up 1.5%. So that is non-farms for another month. We've seen a decent number come through once again. 250,000 jobs created during the month of October, well above expectations to 200,000. A noticeable improvement on last month's figure, which was revised down from 134 to 118,000, still showing the impact of those hurricanes in the Caribbean. Unemployment rate, of course, at 3.7%, just in line with expectations and still nicely where the Fed likes it to be. And finally, those wage numbers as well, up 0.2% month on month and 3.1% year on year. My thanks to our guest, Anthony Karaji from Phoenix Partners, for joining us today. Thank you for joining us on this non-farm payroll special. We're back as normal on Monday morning at 7:30. Thank you for joining us and have a good weekend.